The US markets are starting to slow, but JP Morgan and other banks say the end is not near. The problem is, can we really trust these statements? We'll look back in the past history to see certain times when this has been said before. So soft landing or not, we know that this week is inflation. Volatility of the volatility is spiking up. And for traders, investors, and of course, everybody else out there, we need to be looking at a few charts. In particular, semiconductors are in focus this week, and also AAPL. The biggest stock in the world has fallen for the first time in 5 months. What happens next? Well, it did close on its low. Join us as we cover stocks, commodities, and cryptos together. Well, welcome back everybody to the Daily Show where we discuss markets around the world. Let's do a quick analysis here of the macro leading indicators and of course the hottest charts throughout today's video. But first up, I wanted to start with Apple. It fell, and because it's the biggest stock in the market, it was a big deal. Now, if we take it for a week in advance, we can see here that Apple actually fell around 7% during the week, along with some of the other huge tech stocks. Amazon bucked the trend, though it did hit resistance on the Friday that we'll look at later on today's video, along with some unusual volumes that have been coming out for some of the stocks. Stick around for that. There's some great stuff coming. Let's discuss, though, inflation moving forward. And in particular, let's talk about what usually shows us that inflation might be actually spiking over the next coming months. First up, CPI versus diesel price. As you can see here, oil, diesel, everything has been going up over the last month and a half. And we're now starting to see a huge divergence between Harbour diesel pricing and CPI year on year. I think it's pretty clear we're going to get a spike in inflation. We're also seeing the same thing across major shipping lines. All of the prices have started to increase after bottoming only a few months ago. So again, it's kind of like the calm before the storm. Are we going to see a spike in inflation? It seems likely, but I want to see your comments down below. Tell me whether you think it's going to happen this one, next one, or not at all. Let's talk about markets into this earnings season. As you know on this channel, if you've been watching for a while, we talk a lot about forward PE ratio. We know that as investors, if we want to invest, somewhere around 16.8 is usually a great average price. And we've had that already this year and last year and some other periods of time. But from an investor's perspective, is the market cheap? Well, it's trading around 19.57, probably about 19.3 at the time of this recording. And is that cheap? Well, not really. I mean, it's kind of expensive. So therefore, you've kind of either got to be patient or find the right sectors within the market that remain kind of better priced overall. And which sectors could they be? Well, we've seen, according to the Bank of America, small caps get massive inflows over the last month. And it's no surprise that small caps are actually holding the best during this sell-off. So is it really like a brutal sell-off in this market? Well, at the moment, not really, because it's not sustained across all stocks. It's mostly technology stocks that are really getting hit the hardest. And we'll talk about that later on in today's video as we cover the indices together. We already mentioned that surging demand for calls was getting a little bit high. That usually means that we need to do a turnaround, and we always watch this type of chart. But more importantly, sentiment surveys continue to come in incredibly bullish. 49% of respondents believe that the market would be bullish over the next 6 months. Only 21.3% of respondents said bearish. And this is a consistently very high rate of bullish sentiment. Remember, historical averages are 37.5% bullish, and we were seeing in the lines of around 20 or 30% for a while until everything flipped about a month ago. And that month is going to be important when we take a look at where Apple is now in response to the last month. Let's discuss, though, whether we should be freaking out at a sell over the start of August. We've talked about this being the weakest time of the year. Yes, it is. Yes, we usually see these types of sell-offs. But here's some great data stats here from Wayne Whaley. And basically what it says is that if we do see the sell-off at the beginning of August, then in almost all periods of time, we will see positive year-end results. Now, I think that's very consistent with some data we'll bring in very, very soon. But take a look at this. When we start to see selling in August, we often do continue to see some weakness through the August period. September can kind of sometimes be a little bit better. October, a bit mixed. And then super bullish kind of Novembers and Decembers in these scenarios. Well, let's take a look at pre-election volatility years, because of course that's where we find ourselves right now. Have we seen a spike of volatility over the last week or two? The answer is yes. Do we continue to believe there will be spikes of volatility at this period? Absolutely. We had a downgrade of the US the first time since 2011 in terms of Fitch's downgrade last week. And we know that this is where kind of bad news often comes at the back end of the earnings season, where we've now seen over 80% of the market capitalization of the S&P 500 return. Here's where volatility generally spikes up again. We're about a few days into this. So is it usually sustained? It's usually through the next 2 to 3 months, August, September, and October. They're the ones we have to watch out for. So what happens over pre-election years? Well, we tend to sell off, then we have a bottoming effect, then we come back up, and then of course we usually sell off for some kind of double bottoming effect until usually a run for the end of the year. Now, have we been following a very similar style this year? The answer is yes, we have. We've seen similar sell-offs. We've seen similar periods of time where we've had weakness. And a lot of the next weakness levels will be most likely after August and usually around OPEX. I would say the week leading into and the week out of September OPEX in particular needs to be considered. That is when we see all of the options expiration, the quad witching hour events, and more importantly, some huge data reads. If you're interested in that type of stuff, make sure to subscribe to the channel. We will be covering it over the next couple of months, and there's going to be a lot of volatility for day traders, swing, and of course, investors. What about seasonal trends of Apple? Does this tend to happen in pre-election years? Well, I took all pre-election years, and I can tell you that in general, Apple does struggle around these next couple of months. And you can see it's already started to sell off to what is a traditional sell. However, it's well above average with gains in terms of overall markets. Usually it's made about 20-something% by this time. This time over, it's 50+% on the chart. So there could be some more fall coming. We'll look at that soon. Let's go into unusual volume trades now. So first up, we saw Treasuries post a pretty nice trade. We do know that 94 was one of our 3 target levels. I still think 90 is possible, or 88 to 90. That's kind of like that big kahuna investment level. If people are looking at it on the charts, that's got to be a zone that everyone's looking at technically. But as treasuries fell, we saw a little bit of a bounce. Is it just a relief recovery? It certainly could be. We mentioned at the beginning, we talked about semiconductors. Well, here's SOX. Big trade going through on that. Is this going to be a double top, or is that just a buy the dip? Well, historically, there were a lot of trades in this back in 2022 before we saw a massive sell-off on semiconductors. So it's most likely someone taking profit, some big player getting out. If it does fall through, we know that semiconductors could experience some quick selling, and that of course is going to fall the market a little bit more because semiconductors are not even really arguably the most important sector to the US market. It's the big thing that's driven outperformance over the last 15 real years. If we have a look at Chinese stocks now, they're looking a lot better. We've seen some buys through KWEB. We've seen buys through Yin. We've been talking about the CQQQ. We do think that there's stimulus coming for China, most likely somewhere around October. They've already said that there's something on the horizon, but they haven't announced it. And the stock markets have been getting volume trades back into them. So that's something to watch. And then there's another market that we'll look at later on, which is, of course, TAN. Solar has been getting smashed. But is there a switch coming? Well, we'll talk about that later on today's video. All right, let's talk earnings this week. There's still big earnings to come. Here are some of the biggest names on the horizon. And of course, Disney is also coming. This will be a big one because it's been suffering heavily on the charts for some time. If it falls through, there'll be some levels we'll cover for Disney later on. Make sure to subscribe for that. We've got Palantir as well. Some of the traders in this community's favorite. They love that one. So Palantir is coming out, PLTR. That will be after the close on Monday. So make sure you have your earnings calendar. Let's now take a look at the earnings beat data, and we can see 68% beats 1297, misses 602. Is this a good earnings season? I'd say it's just under average. It's pretty damn good, and it shows that the market was probably right about a lot of those earnings. However, the forecasts are starting to come in, and we saw Apple post another kind of revenue miss, and that's going to be a big deal here when it comes to moving forward. And speaking of Apple, of course, it fell 4.8% on the Friday trade at a 2.93 times options per daily volume. That's a huge deal. Still, the options were mostly in the call side versus the puts, but this is just a huge amount of trade. We also saw Amazon trade at 3.5 times after it beat. It hit straight into resistance. We'll look at that later. And it almost did a double call to put ratio. Well, it was just a massive day on it. And if we scroll through, there's a few other big plays that have happened. Some other ones that have continued to show and surprise have been the healthcare stocks, Moderna, Johnson & Johnson. Moderna in particular, that's been getting smashed down every single day. Could it be going towards capitulation? We'll be watching that, I think, over the next couple of weeks as it is showing some interesting levels. Disney's another one in focus this week. It's had a huge amount of calls on it for a long time while it's been slowly dwindling down. What will happen with the earnings? I think the sentiment is pretty bad moving into it, so maybe it will surprise that bad sentiment. Today's options volume was massive on Friday, 48 versus almost the average of 40, 54% calls versus 46% puts. So still very driven towards that call by the dip style scenario, which allows the market to potentially fall a little bit more as retail have been so conditioned to buy the market. This really does look more like a significant sell-off, and the reasons why, well, we already knew it was probably coming because it broke under the daily 20s, and then that's why we're getting these sells. And we'll look at the indices later on for that. For the trade session, it was not defensives doing well. So again, that's not usual. And certainly consumer discretionary was being held up by Amazon. And if we move over to the last 5 days of trade, the inflation trades have all been there. Financials, agriculture, energy, and banks. So in general, of the top kind of 5 to 10, it's almost all been really something to do with inflation. You know, we're seeing energy trades going through, and we've had that now for over a month where energy's been pretty strong. And this is showing you that the market's clearly front loading a CPI increase. So is it expecting it? Will it be a shock? Again, your guess is as good as mine, but I'm interested to read your comments anyway. Let's have a look at solar. Now that was down 8.12. As we mentioned, unusual options or unusual trade activity happening on that one, and something we'll be looking at as we get into the charts. So just before we jump into the charts and we take a look at all of the key levels that you should be looking at this week, and boy, oh boy, there's some big ones, I want to say a big thank you to the sponsor of today's video, which is Tiger Brokers. Now, as you may be familiar, Tiger Brokers have been upgrading their platform over the last year in particular, and really putting in some of the things that I've given them some feedback thanks to you in the community. One of those has got to do with investing calendars, and more importantly, being able to create watch lists, positions, and also have the latest news at your fingertips on the right hand side. It's also super helpful to be able to select your monthly, daily, or weekly views, and then to be able to go through and of course individually look at the stocks. One of the things I really like to talk about is of course using price trend targets and understanding that there are upgrades and downgrades in the economy. And more importantly, for individual stocks, you can get all of those plus all of the financial segments, short interest, dividend statements, and everything else this earnings season within the platform. So what are you waiting for? There's a bunch of special offers down below. Check them out today. So let's jump into the charts right now. We'll look at the US 2-year to begin with. Because we have inflation figures this week, still set alerts at 5.1%. If we see the US 2-year go above this level, this sell-off could get a little bit more significant faster. The fear of the unknown is always the big thing for traders in markets, so that's going to be a big one. Also mark out 4.6. If we go under there, maybe that might mark a low in the markets or a level of demand that you might want to be looking at. The sleeper, which we haven't actually covered enough yet, and we will eventually, is JP10Y. Mark 0.7, 0.8, and 1 for this. The Japanese Bank of Japan have literally changed something they haven't done for years. It's a big deal, and eventually it will cause some stir in the market, I'm sure. What about RSP? So the equal weighted market was falling through the Friday session, and it's been falling in line, but maybe not as aggressively as the NASDAQ. So it shows you that this rotation is really aggressive towards tech stocks in particular. We've seen treasuries get smashed as well. They hit kind of a secondary target. They found some buyers. We have marked out this 88.90 level down below just in case. But really, treasuries are getting into a pretty big sweet spot. It just depends. Like as a trader, it's going to be very difficult to buy here. As an investor, you're looking at it and saying, damn, that's getting very cheap. That's back down into these levels. You know, we're seeing pricing that's consistent with a very, very, very low level over the last, decades, really. So treasuries are getting interesting. And could this be the final shakeout? Well, it's starting to look like a pretty interesting zone into inflation. We'll come and cover that. HYG or junk bonds were definitely showing signs of life for the market in comparison. Junk bonds were up, market was down. That's because US 2 yields dropped, but yeah, that's an interesting one. If that continues, then it's showing you that maybe the buy the dip reflex is there as we sell off from this market. We'll be watching junk bonds closely. We saw consumer discretionary versus staples, which is kind of like tracking 1/3 of the US economy, as 1/3 is consumerism, increase. So that was a positive sign, I guess. But I have, on the flip side of this, been looking at some of the collectible markets, and I can tell you they continue to fall into this summer back-end period in the US. Now, it's normal for them to have a lull here. So I think this year's pickup in Christmas is going to be super important to show us whether the American consumer is really weak or not. That's more collectible markets. It's not really to do with trading, of course, these markets here, but it's something I do track, and I can tell you a lot of those are down across. Magma, no fall to a new low yet. That's our special little kind of market indicator we're looking at. And copper gave a false break last week on the daily, then kind of thought maybe 4.12 and fell straight back down. So we do have our line in the sand here on the weekly closes. We know where copper will get more bullish, which probably is going to come with something like Chinese stimulus. But at the moment, demand destruction still seems to be in place. The market cannot take a trick here on copper. We just cannot see a proper recovery of this metal, and we'll continue to follow it. We talked about oil. We talked about the fact that we thought it'd rally and then maybe find a little sell. Well, it didn't. It came straight into this supply, and we find ourselves at the closure here into inflation. What a run it's had, though. If we take a look at inflation and in general what oil's done into this week, if we go back to the beginning of kind of July, which is basically here, it's up 18.16%, and off the bottom like 20-something%. So I'm sure we're all feeling it here. We know that this has gone up. We know that there's been a lot of manipulation from OPEC into this particular market, and it closes right into resistance for the week with a new higher high. So if we take a look at a 15-minute chart and we scroll down for oil, there'll be a lot of trading on this, but we've got that new higher high. We have our base in. This looked definitely long. This is actually where, somewhere around here is where you would have thought the shorts would have come through, and it sat there for a while, and then it took that new high. Now, that could mean there's more spiking to come, but we now have some good bases. We've got this level, which for day traders, they're going to be looking underneath. And then we also have, for swing traders, a nice low in it as well. So if we end up getting this, swing traders might want to keep failing on oil at that point. But it's in a bull trend at this stage, so no reason to be bearish yet, even though we're at a massive supply. Let's move over to the US dollar. This one did fall as expected. This was a beautiful trade here. Very similar to something we do in our day trading masterclass. If you're interested, links in the description down below. But in particular, this was falling off and it came back down to that previous level of demand. So we found a little bit of reprieve, a little bit of buying. Let's take a look at the weekly here. Big rejection off the dollar. And this week it'll move based on inflation. But that's a big rejection off the dollar into our green box. And this was our second level where we thought shorters might show. And they did. And that led into gold that actually saw recovery. So gold during non-farms took the low, then boosted back up. And that's a good first sign for gold to actually find the recovery. Right where we were discussing it, that 1935, 1930 zone. We've been talking about this a lot. We've seen the first time frame changes of trend. We've now got some bullish action and, of course, levels that we'll need to clear this week to find more bullish action, 1955 and higher and higher. Now, what you're actually looking for this week is even if inflation goes up, you do actually want yields to go down. So US 10-year and 2-year, if they're falling, probably going to be good for gold. If we see yields go up and through 5.1%, I'm not sure if gold will hold the zone. But at this point, I like what we're seeing. We get the right first time, little time frame kind of turns. And if we go to the weekly, you can see here, it did find a little bit of a spike into the close. So at least it held a bullish kind of sentiment. It took out that long leg doji, which is generally an indecision style candle. And I like what I see on this chart. So I'm hoping that this holds up and the lows from Friday continue to hold. Let's move over to central bank liquidity now. The Qs are very disconnected. Nothing much going on in the basics of central bank liquidity. Still very disconnected from the price. Then we move over to Apple. And this one here has more to fall. Now, how much more? Well, the weekly 20 is actually fast approaching. As you can see here, it's almost mean reverted in only a week. So that's a big engulfing candle that creates a change of trend. Rallies should be met by sell demand. Look at it. It closed on its lows, usually meaning, again, rallies are met by sell demand for at least the beginning. So buy the dip at this stage could be kind of gone from the initial rallies. It really gapped down. It fell all the way and it put in a pretty big volume day as well. So there were some large trades. Now, where to next? Well, I would think this is the next stop, which is around the price of 178. If it does find a bounce here, which would be probably fair to say, then it's probably still going to go maybe a little bit lower. Looking at previous highs as well, previous demand through here, 172. It'll make sense when we look at the S&P just in a few moments' time. Amazon hit resistance, 144. Big deal here for it. Yes, that's very nice. 144 is not too bad at all. And then as we scroll through, that's just basically a resistance. We see tan. So this was the one that had a big buyer on it, or we can assume it's a big buyer. So some large trader came in and probably got excited about it. Now, remember, they don't work on necessarily your trading strategy. They're just buying on selling positions. They don't have stop losses because they trade monster money and they rotate in and out. So all we know is a large trade went through there. It's closed on its low. So it's unlikely to be instantaneous buying, but there is a price coming down, $60, that could be of interest. Now, I'm not too sure whether we've got no turn trend here or anything like that, but we might follow this because even the chances are that this is possibly an island reversal setting up. We gap down, we sit here for 3 days, we hover, we gap up. Well, it's going to be interesting. So always another opportunity in a different market, even markets you're not looking at. No activation yet, still looks horrible on the charts, but something we're looking at. Let's move over to Tesla. It fell, which is good because we kind of expect it to go towards 240 and then maybe find some buyers. But at this point, it broke out of that little coiling range last week. It rallied back up to the conservative entry and we saw selling. New low should bring 240.50. Hopefully that happens just because it probably makes more sense on the charts. I'm sure some of you are like, I don't want that to happen. Well, that's what the charts are telling us at this stage. CQQQ, Chinese stocks in general, finding a nice bounce on them. Nowhere near down as much as the rest of the world was. And it broke out of that huge trend line, held it last week. Big deal. So we held the close here, and we bounced. So could the bottom be in for Chinese stocks for now? It's looking more and more apparent that that could be the way. And this is the first time I've really liked them. I liked them in this area. First time in a very long time. The charts look like a monster inverse head and shoulders. I'm sure a few people are screaming. Look, there's always risk in everything you do. So, don't go and do anything in particular. Make your own decisions. Patience, react, don't predict, and of course, control your risks. Let's go over to the German market. So this one closed down. So if we look at the weekly here, it looks like it's done a UTAD. That is buyer's climax, UTAD. This is what we call a Wyckoff distribution, and it's gone back for another kind of high hit. Now, the key level is going to move forward is it seems hard to believe that the German DAX won't want to go back down to that 15,600 level. What happens here is going to be interesting and pretty important. So 15.6 will be a zone that we'll be watching. There's no real sign of turnaround yet for the German market. It almost closed on a new low, but because we do have a lower low point, you could be a bull if you clean through this area here. So small time frame traders could be like a little bull, then maybe something like that could be an occurrence. German market, pretty interesting chart. ASX 200 for the Australian viewers out there before we go into the US, not so interesting. It's just kind of sitting at a level where you'd expect buyers to recommit, but it's not that good. I don't like that level very much. US 2000 onto the Russell 2000, no new low. So still very strong market. Russell 2000's been doing well. If it does fall through, the next logical steps are around the low 1900s, like 1920 or 1896, which will bring us back into this area in the most traded zone. I would say that if this market does fall through, it's probably moving towards here. And yeah, it's holding its own for now. So US 2000, one to watch this week. We'll cover it closely. Now we'll move to the NASDAQ. So there were a couple of interesting trades here. In the private community, we were talking about technicals showing the bull sign right there into non-farms. And then they went straight up. And you can see kind of the target. I'm not changing anything. This is exactly what I said. And then the market went to a new high. Now, usually at that point, I would break even the trade. During non-farms, it really shouldn't come back again if it's going to be a slingshot trade. You can see it came back down. It's not out of its low yet, but if a new low, the reason I want to show this is because if a new low had found, so that would have been a break-even trade, or you're in it with stop losses still very, very tight. But if the market does take this new low, that's fairly significant because it's actually botched that kind of pretty consistently good turn event, and we're making it underneath the long leg doji. So the next stop is going to be around 15,000. So that's another from that point, that's another 250 points away from the NASDAQ. So it's going to be a very significant extra little bit of selling that's going to push us into some things. We're underneath the daily 20 now. We're going towards, you would think, that weekly 20. That's going to push, the idea of 6%. The problem is, how does it get there, and how many bounces and how many sells and all these types of things. Ultimately, it's going to come down to inflation and the way that the market wants to trade around that. But let's go over to the S&P 500, another daily close near its lows. And when you get things like this, you do tend to see rallies being met by sell demand. So we know there's big trades in both the Qs and SP 500 at the tops. We know that some of the leverage trades are being closed already. And we do also know that there is a big gap to be filled at 44.40. So that's going to be a target that I think people have early in this week if we do end up continuing the selling. And if we go to the smaller timeframes, and we'll use the futures market for this. Look at that engulf, by the way. Big engulf market closing on the lows. Definitely a new low on the S&P. So showing that it really means more business here in terms of selling. And as it broke through, look at this. It broke through that supply and then just instantly rejected it, not getting a close above. So yeah, that was that supply, that support becomes resistance area. It tapped that and just got sold ruthlessly into the close. So at this point, we know that there's sellers in here. So if the market rebounds, 45.20, 45.30, that's where you expect sellers to happen. Now, if the market takes out 45.40 this week, the buy the dip guys have just done a serious move. So I think that, there's a lot to be taken from this structure that was caused over Thursday and Friday's trade. We'll be watching it more closely. At the moment, it looks like rallies to be met by sell demand based on the daily close, based on the breakouts and all of those things. Remember, it has changed trend for swing traders as well as it went through here. So swing traders theoretically are looking for this thing potentially to do a mean reversion and maybe to show further weakness in August. Some of the key levels with the SPX we found before. Now, Bitcoin's been a conundrum. It's sitting at 29,060. We talked about 29,259 being a level, and I spoke about this on the Friday as well and said I think the trade is very questionable at best. So the idea was something like this into the long. It just hasn't done it. When something sits for this long, usually that's a very question mark for me. Now, it's gone back to the entry price several times, so it's not like you can't get out. I just don't think, break even and just go, okay, well, that didn't do what I expected it to. But sometimes you got to say, well, why is it still sitting there? And that's a big question. Why is it still sitting there? It just continuously weakens off. The most traded zone, 28,000. We saw a little bit of recovery, but you can also make an argument that that's supply and the market just tapping that for selling off further. 30,400 would have been a big difference. So Bitcoin, I'd still say, is probably marking on the side of weakness, even though we had that little activation, which just didn't do anything yet. For this week's big news, though, let's take a look. We've got Chinese CPI here. Then we've got the big one, Thursday, August the 10th. Stick around on the channel for this one. It's going to be massive. CPI coming in 8:30 a.m. New York time. That's going to be a huge deal. And that's something that we'll be watching very closely. Now, if we also take a look at what JP Morgan said just for the end of today's video, they said that their third quarter 23 growth looked solid. We no longer anticipate a recession in this calendar year. Recession risks are elevated next year. Well, yeah, because I just wanted to mention this. 6 months after we start to see jobs actually turning bad, that's when you get a recession called. So there's no way that you're going to get a recession this year in general. So if inflation doesn't continue to ease, more Fed hikes and rising odds of a downturn will come back. Well, do we expect CPI inflation to go up based on oil price, based on the shipping stuff? I guess we do. So again, this will be an interesting factor, and it just shows you that they say all these things sometimes, but then only a week or two later, it does the opposite. We'll find out soon. But waning post-pandemic disruptions and waxing supply-side development suggest upside risks as well. So that's just like a get-out-of-jail-free plan. So really what this statement is saying to us is you can't trust whatever you read anywhere. There's two ways to read this. What I think we are looking at is obviously CPI being a big number this week. And that's why I chucked it at the end of this show because, of course, firstly, if you've stuck around, thank you very much. But it's got to do with this CPI. And this CPI will show us a little bit. It could spike the overall longer term yield curves, which we'll look at in the next video of how high they're going to remain according to the market for longer. But this is going to be a big thing. Thank you very much for watching. If you enjoyed today's video, then make sure to subscribe, smash that like button. And remember, if you're interested in the sponsor of today's video, links in the description down below. Thanks so much, guys. Catch you in the next one. Bye for now.